and to improve my educator capabilities. So thanks everyone for joining again. Let's move to some hard skills module. If you go to your folder, let's see if I am able to share it this way. Earlier this week I released a video about what your pathway in accounting theory can be. I will do a brief overview of that here. If you have any questions about that, feel free to ask. We will move on based on that 10 points, and you kind of feel free to ask any concept you feel you have trouble with, and I will return and explain it again. A short note on the learning techniques. The standard learning technique is spaced repetition, when you learn the material and then you come back to that material and you learn it again. The other techniques are when you try to build a material into some story, and you can try that story because story is something easier to remember. So let's say we need to do point 1. We need to understand the concept of accounting entity and the concept of accounting transaction. And that might be easier to understand just imagining that let me do a bigger font here. So accounting entity, it is a separate construct which has its own operations which are separate from the owners of the entity and from the employees of the entity and from the managers of the entity. So that's just you can imagine like a grocery store, Walmart. Walmart records its transactions like inventory in, cash out, inventory out when sold, cash in. And if some employees do some transactions with their personal money, even if it happens inside Walmart, those transactions will be not on a Walmart books. So if Walmart employee buy some stuff in the Walmart for his own funds, the Walmart will only reflect Walmart side of the deal, like when they dispose the inventory and they record the cash in. They will not record whatever happens to employee own money. And the same happens with owners. When you are an owner of the business and you, for example, take money from your business and you spend this money on your personal items, that will be owner's draw in the business. That will not be an expense of the business. And for those who live in United States, the concept of separate accounting entity is more or less easier to understand because many people buy and sell stocks or stock indices, and the listed companies are good examples of a separate accounting entities. They are separate from whatever shareholders of these companies do with their own money. What I advise you to do here is, if you still have some lack of understanding of the separate entity concept, You can either ask a question in Q&A or try to Google or search for other videos on YouTube. It's always good to get several perspectives on the issue. Like I listed several definitions here. You can go through them, but the main parts which you know about accounting entity is it is segregated from the personal transactions of whoever is involved in that entity. It should be segregated, and when it's not, it can bring various kind of troubles, like IRS troubles, legal troubles. If someone messes up his personal expenses and his business expenses, it can end up in some fines and penalties, depending if you underpaid your taxes because of that, or for example, your business, if it's an LLC and you do your personal operations through an LLC, your LLC will provide much less legal protection to you, to your personal assets. Second, most of the times accounting entities are also established as legal entities, like corporation, LLC, sole proprietorship. Even sole proprietorship sometimes requires some registration with the state, so we can say that it also has some legal status. The third point is that your accounting entity, it owns its own assets, and these assets belong to that entity, and it also owes liabilities to some third parties, or it can be a liability to the owner, and that accounting entity is owned by someone who provided an investment in that entity or who established it, who is its shareholder or member or owner, depending on its legal structure. And if your legal structure is an LLC or corporation, accounting entity also, not accounting, a legal entity, but most of the time it will correspond to accounting entity. It will provide you with protection for your own personal assets if your LLC or corporation gets into legal trouble. So if your LLC does some unintentional damage to someone and someone sues you for reparations, for damages, he will not be able to go after your personal assets as an owner of that business. There are nuances. If you are the manager of that LLC and you intentionally cause harm to someone else, even if you were acting as an employee of the LLC, there can be a legal action taken against you. But most of the time, corporation and LLC will provide you protection for your personal assets. And when you are a partner, usually like an unlimited partner or sole proprietor, when you do business, all your personal assets are kind of at stake of that business. And if your business doesn't have proper insurance and get into some accident where you have to settle damages done by your business, the person who sues you, he or she, they can came after your personal assets, and that possesses quite a bit of risk. So one of the benefits of studying and learning accounting and knowing accounting is it will equip you with a skill to kind of establish any business properly with and make you being able to understand the risks involved in starting your own business, even if it's not an accounting business. It works similarly to any business, and to protect your assets and to get owner's liability out of the equation. And your accounting entity also can engage into economic activity, and that engagement into economic activity is called a transaction. So we have a short definition of accounting transaction here. It is some event or operation or activity which resulted in a monetary impact on an accounting entity or on an accounting entity financials, which is the same. Usually when we say that something has an impact on an entity, on a company, we mean that it has an accounting, it has monetary impact on a company, because company most of the time is all about money, all about monetary impact on financial statements, and it is very true, 99.9% true when you look at it as accountant. So whatever you will do as accountant will always involve monetary impact or potential monetary impact on the entity. So that is definition of transactions. And let's switch for a minute for accounting transaction practice file, which is in the homework. I will share it here, and we will work and improve that file over time. But so far, I want you to go to transaction list, and from that list, you can get a basic grasp what a business transaction is. You can just review the examples. Maybe when you looked at the theory, you weren't getting an understanding of like intuitive understanding what transaction is. So here is this list with transactions, and if you read them through, you will kind of get even a better grasp of what it is. I will read couple, and you can take your time and read some more. Like, for example, when you establish the business, you invest some money in that business. So you go open a business checking account, and you either deposit cash there or check, or you transfer from your personal account money to that business. And in that situation, the business will make an accounting entry, which will be cash and equity. So you put money in the business, and you recorded that your business now owns, let's say $100,000 cash. And the business also needs to reflect that he obtained it, that it obtained money from someone. And because you are the owner of the business, it records a kind of a equity investment from you. You can see that I have positive amount here and negative amount here, and that's because I want my kind of equity equation, accounting equation to balance. And that is moving us to the next step in our accounting theory journey. Let me know if you need a few minutes to read the transactions. Let's say you can read first 3 transactions, because we will go back to transactions just in a few moments. we will discuss accounting equation, and we will come back to transactions just in a few moments. Okay, so in order to explain you why I have debits and credits here, and why I have positive and negative amounts, and you also can see that I have 0 at the top, and that 0 is just the sum of all transactions. I need you to explain the concept of accounting equation. Let's see what we have here as a second step in our theoretical journey. So our second step is to define accounting equation and its components, and why debits credits exist, and why debits should equal credits. Let's open accounting equation document. You can find it here. Let me know if any link is not working. Then I will have to do something on my end. Okay, so what accounting equation is? Someone who is familiar with reports of the public companies or with basic accounting knows that a company has balance sheet, and on that balance sheet your assets are equal to equity plus liabilities. And if you present it a bit differently, you can say that your equity is equal to assets less liabilities. And that concept, you can know that concept from your everyday life. When you buy a house and you put a down payment, and then in some time your house appreciates, you can get some snail mail from the bank saying that you now have some owner's equity in your house, and you can get additional loans to kind of cover your cash needs and make some extravagant purchase, or spend on vacation, or spend on house renovation. So they try to sell you a loan saying that your equity in your house increase, and you can withdraw some extra money for that equity. And when they send you such advertising, what they mean is that your current market value of your house, it can be real market value, or it can be some assessment, or it can be number from Zillow, depending what each lender will use. So your market value of your house less your mortgage outstanding is basically your equity in your house. And the same concept works for balance sheet and for accounting equation. Basically, what you own, which is an asset, less what you owe, which is a liability, is your equity. But usually on the face of balance sheet we have assets on the one side, and we have liabilities plus equity on the other side. And we have that presentation, so that goes back to like 700 years ago, when Italian Luca Pacioli decided that he wants to have a snapshot of financial position of the entity, which will show its assets, owns, and sold. So he wanted a statement which would show what entity owns its assets and what sources of financing entity use to acquire those assets. So for example, if you invest your own money and you buy some assets in the entity, even our basic example, we put 100,000 cash in entity. In the assets, we have cash. It's now the entity's assets. On the other side of the balance sheet, we have equity because it's owner's investment. And that was the source for the entity's assets. And if you acquire something with a debt, with a mortgage or bank loan, even if it's cash, you will have more cash on your balance sheet, but you also have additional liability on your balance sheet. And one should always equal to another. And because we wanted to have such a report, such a presentation, that is why we need to, every transaction we do, we need to have a debit and credit for that transaction. Because if we don't, our balance sheet will not balance. Our accounting equation will not work. That's why basically debits and credits exists. It's not just there were some debits and credits independently of whatever happens, and someone decide, okay, let's build all these debits and credits into balance sheet. It is because we want our balance sheet to balance. That's why we have debits and credits. Of course, you can Google the definitions, like that debit is some increase to something or credit is some decrease to something. But you, on the start of your career, you just need to know that debits and credits exist only because we need our balance sheet to balance. And that's why every transaction should balance. Let's now look at the list of our transactions and see what we can do with debits and credits. What I am doing right now is I'm looking on the transaction and I see that, okay, so that is cash and that is an asset. And here I have an equity because it's owner's contribution. And then on the second transaction, we say that we bought a building with a 50,000 down payment and 150,000 mortgage. And we record the transaction here. Okay, and building is worth 200,000. It's like buying your own house with 25% down payment. But that's a building for the business. So we say, okay, building is 200,000. We spent 50,000 cash on it. So we gave that money to the owner of the building or to the escrow account, and the company lost that cash or invested it into building. So we need to remove $50,000 from our books. And we also got a liability to the bank, which is mortgage. And that liability was for 150,000. And our entity, now it balances. So the entity balances is 0. And we can say, okay, what is building? Building is an asset. What is cash? Cash is also an asset. It's something tangible that we own and we can get future economic benefits from it. And what is mortgage? it's liability. I believe since you live in United States, you already intuitively understand all of that. So okay, asset, it's kind of something that we own. It can decrease too, like when we spend cash on something, our asset decreases. And what's okay, a mortgage obviously is a liability, or like the same as credit card debt or any other type of liability. So, but what's the formal definition of an asset and a liability? What's the framework to decide which one is what? For example, if we say accounts receivable or deferred revenue, how do we know if one is asset, accounts receivable, and deferred revenue is a liability? So we can go back to the file and check the definition. So asset is something that we own, and that object or intangible assets or tangible assets, it can generate value for us, and it can provide the entity with a future economic benefits. So probably key to definition is future economic benefits. So like if you have cash or property or accounts receivable, where it's when you expect your customer to pay you for the something you already sold to customer, or inventory, it is all sources of future economic benefits. And liability at the same time is something that you owe based on some contract, even if it's oral or written contract, something that you owe usually to third party. There can also be a liability to the owner, depending on the legal agreement which you have. So entity can borrow money from the owner, but that should be separate from the equity component, because equity, on the one side, equity is like what is left when entity settles all its liabilities, and on the other hand, it is so accounting meaning is the same and mathematical meaning is the same. So equity in the business is whatever you initially invested in that business, you or shareholders of the business initially invested in that business, less whatever was withdrawn by shareholders, distributions, plus or minus accumulated profits and losses. So if your business loses money, your equity decreases. And if your business is making money, making profits, your equity in the business increases. And if you do withdrawals, if you, like, as an owner of the business, if you withdraw the money from the business, your equity goes down. So these are the formal definitions. And if we circle back here, let's do a recap. Okay, we have cash here. And cash is something which we own. We do not owe cash to anyone. And we can get future economic benefits from it by the way of like investing it in some certificate of deposit, which is currently not a good investment, or equities, stocks of the other companies, or we can invest it in inventory we can buy some merchandise and we can sell that merchandise with profit. So there is a lot of ways to benefit from cash on your balance sheet. That's why we say that's an asset. And equity, because it is owner's investment, we can confidently say that it's an equity. Most of the operation with the owner will be equity operations, like withdrawal of money from the business, equity. If you do some personal transaction with business funds, you will show it as equity, as withdrawal. If you pay yourself a dividend, it will be equity. If you contribute money to the business, it will be equity. You can be, as an owner, especially in the S corporation, you can be on the payroll of your business. And that payroll will be actually an expense. But IRS will have their own algorithm to figure out. Actually, as an employee, as an owner of the S corporation, you will have to have employees in the S corporation. And if you are the only employee in the S corporation, you will have to pay like a reasonable market salary to yourself for whatever you are doing. But let's not overcomplicate our issues. When we deal with owners' investments, it's an equity, 100% guaranteed. Okay, second step, we acquired a building. Is a building an asset? Do we own it? We kind of, because it's a mortgage, we can argue if we own it in full or not, depending on the contract. But generally, you kind of own it, and you can get a future economic benefits from it. I would say that ability to get future economic benefits from something is a better asset test compared to just owning the asset. For example, if you legally own some asset, some car, and it was stolen and you have no access to it, and you cannot get any economic benefits from it, and you do not expect any recovery from ownership of that car, so no insurance, nothing, then that car should not be on your books, because there is no expectation of recovery of any economic benefits from that car. And that's why building is an asset. Cash, it is still an asset, though it is a decrease in cash, it is still an asset, because we do not look at what monetary impact an asset or liability have. We only look what is the substance of that asset. And the mortgage is a liability because we will have to pay the mortgage, and we will have to pay for it with cash, which is an asset. Or we can also kind of give lender opportunity to foreclose on us, which we don't want. Then we will kind of settle that mortgage with a building, which is also an asset. So basically, a liability is something which leads to outflow of economic benefits from you, and which usually you settle liability with an asset. You can do it in a more complicated way, like get another loan and repay the first loan, or refinance, and technically you settle one liability and get the other. But we need to look at the substance. And the substance is that any liability is an outflow and of economic benefits, and usually that outflow means that there will be an outflow of assets. So we have several amounts here, And we want to know when do we use debit and credit. And for that, there is a piece of accounting theory which I recommend everyone to learn by heart first, even if you are struggle to get a good understanding of it. I just recommend to learn it by heart first, and understanding will come with practicing and accounting entries. And for that, you can go to debit and credit tab in the same file where we have a transactions. It is a nice colorful tab. And what we have here is the same accounting equation. In the first column we have assets, and I added a list of accounts which represented the assets. And I marked assets by color based on liquidity, like cash is green, the most liquid, and that's the usual presentation in the public financial statements. So you put the most liquid assets on the top and the list. The liquidity is the pace or time it will take to get cash for that assets. So if something is already cash, it takes 0 time. If it's account receivable or inventory, you need to get cash from your customers first, or you need to sell your inventory first, but you can do it pretty quick. And if it's property, plant or equipment or land, it will take a lot of time usually. Please note that all liabilities are red, and I also have some items within assets and liabilities which are marked red, and even one item within the equity. And that's because there are some kind of exceptions to the general rule. And let's not look at those exceptions right now in detail. Let's look at the cash. So what I want you to learn by heart is that list of assets. So you need to kind of, if you think about assets, you need to think about these items first. You need to learn them by heart. Excluding the red ones. And then you need to learn liabilities. So if someone asks you what is taxes payable, you can say it's a liability. If it is easier for you to apply definitions like taxes payable, we kind of have to pay money for that, and that will be an outflow of the benefits of assets. That's probably a liability. If it's easier for you to do it via the definitions, you can do that too. But if you struggle with definitions, you can learn these by heart, and you can practice entries, and the understanding will come naturally after some time. So it is just what I see on myself when I was learning, or when I teaching someone, or when I'm trying to explain someone the concepts. It is not rocket science. It is a bit abstract, and you either get it fast enough, okay, here is an asset, here is a liability, here is an equity, and assets should be equal to liabilities and equities. These are outflows of the benefits to third parties or to owners. These are assets. We expect to get some economic benefits from it. So they should stay on the side of the assets. But if you still have problems with definitions, just learn that by heart, and I can guarantee 95%, 99% of the situations the understanding will come to you later. And we also have a debit and credit columns here and here. And if you look closely at that, you will see that debit column for the assets has a plus and credit column for the assets has a minus, of course with some exceptions. And the situation with equity and liability is the opposite. And that's, again, for something who already knows something about accounting, it's not news, but there is a general rule which says that assets increase by debits, decrease by credits. So if we go back to transaction tab, let me make the screen bigger here. And for transaction, okay, it's already big enough. So what we just said, we said that assets increase by debits and decrease by credits. And that's basically what we have here with cash. Okay, I probably need it to be a bit smaller. So in the column B we have debits and credits, and we already defined that cash is an asset, and it increased in our first operation. It increased, so we debited cash. And in our second operation we paid cash to someone, so it decreased. And if cash decreased, it's a credit. So what is your framework for the accounting entry? So you got an operation, a transaction, and first of all you need to define which accounts are impacted. And it's one more reason to try to learn accounts by heart first, because it will be much easier for you to pick up right accounts if you already know some list of accounts. So you come to operation, okay, 100k invested. Let's add, okay, own funds. Let's just say that that's cash. 100k invested in the company. So obviously, if we say that cash is invested in the company should get a cash, and you put cash here. Then you define, is that account an asset or liability or equity? And in our case, it's an asset. Then you ask yourself, does it increase or decrease? And in our case, it increases. And that's why it's a debit. So when you figure that out, you need to figure out the other side of the equation. So because of that transaction, you see like invested, own funds invested. You kind of start to suspect that, okay, it's owner's funds, so it's probably needs to impact the account which has everything to do with the owner of the business, and that is an equity account. And because it's equity, and you need it to balance, we put like a negative 100,000 there, and we put a credit there, because if we go here and take a look at owner's equity, and it can get a bit complicated here. Let me highlight that part. and that part I will highlight with green. So equity increases with credits. It can get a bit complicated because when we do owner withdrawals or capital distributions or dividends, it will be kind of contra equity accounts, and it will have the opposite properties compared to other equity accounts. I think we will have to run a separate session on contra assets. So we have contra assets accounts here, accumulated depreciation and allowance for doubtful accounts. It will have a properties a bit different from other assets properties. And we have contra equity accounts, which are mostly owners distributions. And their behavior will be different compared to the equity. And I also highlighted preferred stock in red here, because in some circumstances, preferred stock, if you know, preferred stock is the one which can bear fixed dividend, and depending on the circumstances, the preferred stock can be classified as a liability. But let's try to keep our focus on a simple transactions. So we say that equity increases with credits, decreases with liabilities. Or we can say buy. So if we debit the equity, it decreases. If we credit the equity, it increases. And same with liability. Okay, so if we go to our transaction list, second transaction, we can see, okay, building is an asset, and building increased in value. Then we need to debit the building. And then we go cash. We paid 50,000 cash. It's an asset decreased by the cash. It's a credit cash 50,000. And if we go to the mortgage and we say, okay, it's a liability, and it increases our liability. We acquired a new liability, and that should be a credit. One thing that might confuse you. Okay, let's do this way. Can anyone say in the chat if they are confused why equity and liability is with like a minus sign? Does that confuses you? It might be a bit hard to understand. So for example, if cash is minus 50,000 and we say cash decreased, and then we have a mortgage which we get, which kind of obviously increases our liability, and it is still with a minus. So one might say, okay, that's probably a decrease in liability because it's with a minus. But if it confuses you, you may think about it. If it's a liability account, you might think in absolute values. So let's see. just let's see if I have that transaction already there. Okay, business prepaid. Let's say business prepaid 50k cash. Yeah, let's say 10k cash. Business prepaid 10k cash for the mortgage. So obviously cash account is impacted and mortgage account is impacted. And it's 10,000 and our cash decreased by 10,000. So it should be a credit to cash because cash decreased and cash is an asset. Mortgage is a liability. And what happened here? So mortgage decrease. So it will be a debit mortgage. And it will be, yeah, it will be 10,000. So that way our accounting entry will equal 0. Our books will balance because the total for everything is 0. And that was okay, a bit okay, let's do it that way. I will stick for that approach for a while. If it gives you trouble, try to practice it a bit, and then I believe it will stick, and you will be able to manage that. Okay, let's come back. We already ran out of time for that lecture. Let's come back to our schedules. So I wanted to cover a bit more for that module. Like we have another piece of the question, which is revenues and expenses, and we will cover it shortly today because we are running out of time and we have some practice and setups. Okay, so we will do that simultaneously for practice. So I have a question that you need to understand equity better. So the way equity works, it reflects your operations with the owner, and it also reflects your accumulated incomes and profits. So let's move on, and let's say that we already started practice sessions, and we will practice the entries as expected, and we cover a bit of revenues, expenses, and equity transactions in the practice. So let's go through practice transactions first. The third transaction is about inventory acquisition. We acquire some inventory merchandise for $20,000. And we need to reflect that on our books. So obviously, let's add, for clarification, that we do that with cash. So we acquired inventory, and that's obviously an asset because we can get future economic benefits from it. And that assets increased. And therefore, it is debit, because we already know that assets increased by debits and decreased by credits. And we paid for that inventory with cash. And cash is also an asset. But it decreased because we paid it to someone. And therefore, it is a liability. Oh, sorry, it is a credit. It's a bit hard to type and speak at the same time. So if you see in that transactions, we actually have two assets account, and what happens is like a reclass or movement within the assets, but we still have debits and credits for that transaction, and it still balances. Debits are equal to credits. So from time to time, and pretty frequently, I would say, you will see the transactions moving within one account class, within like assets or within liabilities, or maybe even within equity. Let's check one more example. If you might know, there is a requirement to the balance sheet which says that on the balance sheet you need to show your current and non-current assets and liabilities separately. And earlier we booked mortgage with just on one single line, and we need to adjust that. And what we do, let me highlight that with a color. So what we do here, we see where we booked that mortgage, and we kind of offset that account with the full amount, and we break down that amount into current part. So I believe the current part of the mortgage is pretty low because your interest is still pretty high, so you won't repay a lot of your body in your loan in the first year. So current account is something which is due within next 12 months. And long term is something which is due in excess of 12 months. And what we see here is that all three accounts are liabilities. This one is liability, this one is liability, this one is liability. And what we see is that we kind of remove the old mortgage account with a debit. So it is decrease. And here, and we increase our new accounts. Which is credit. Okay. Next, we acquired equipment for $10,000 cash. Again, equipment increased, we acquired new equipment. Debit, equipment, 10,000. Asset. We paid with cash. Cash decreased. It's also an asset, but it decreased, therefore it's credit. This is a bit interesting. This is to give you a grasp of what you will find in accounting standards. So the operation is that we paid a trucking company $2,000 to transport the equipment we acquired to the operation site where it will be operated. And if you use kind of common knowledge, common sense to say, okay, it's probably an expense. We paid a vendor to do some work for us. And it doesn't feel like we get a lot of future values from that. But the accounting standard on property, plant, and equipment, it thinks another way. That's why it's good, even if you are a bookkeeper and you just maintain records, you kind of need to have some knowledge of accounting standards. So accounting standards will say that you need to capitalize on your book not only acquisition cost for the equipment, but also whatever it takes to bring the equipment to your site and to put that equipment into operable conditions. So that is a bit counterintuitive. And so far, you can just try to remember then if you have any costs associated with buying an equipment and putting it into operation, that cost needs to be capitalized on the equipment costs. And in similar fashion, that would have worked with inventory. So if you paid someone to bring your inventory to your place, that cost will also be capitalized in the cost of inventory and expensed only when you sell that inventory. Probably that learning that will require some practice, but it is what it is. If something looks obviously like an expense, sometimes it doesn't. So let's see. So we paid 2,000 cash, and we say, okay, credit cash, outflow, asset, and that's also an asset. I would probably advise you to make a note of such situation here, not to try to overcomplicate things for yourself and think too much about it, but sometimes things are not as straightforward as we wished them to be. And let's move to the next one. Our supplier, the one who sold us $20,000 of inventory early in the year, he decided to give us a credit memo for paying cash. Credit memo is like a discount for future purchase. And he says, okay, if you buy inventory from me the next time, you will pay $2,000 less. What can we do with that credit memo? Is it an asset? What do you think? Is it an asset? Okay, I will not hold long. It is an asset. It is future economic benefits. So we will get our next inventory for less money. And it is an asset, and it needs to be recognized on the book. In some rare circumstances, if, for example, that vendor is going out of business and you do not need to buy anything from him, and you cannot recover any value from that credit memo, in that case it won't probably be an asset, and you will have to either kind of impair it or do not recognize it all, or write off. But in our case we say that's an asset. But that's not cash, that's some other asset. And in our situation, that asset will be other receivable. Receivable is some balance owed to us by a third party. So if someone owes us money, we say that that's a receivable. And in our case, that's an asset. And other part, so other part, what should be the other part of the deal? And if we take a look at accounting guidance, they will say that other part of the deal should be inventory. We need to decrease the value of inventory. In the case we still hold those inventories, if we have already sold this, that will be the different transaction. Let's assume we are going into it in the future, and we still have those inventories on balance sheet. So if we still have those inventories, we need to decrease the value of those inventories, and that's also an asset, and that's a decrease in the asset, and that makes it a credit. Okay, let's talk a bit about revenue, expense, and its impact on equity. Let's say we sold 4,000 worth of inventory for 6,000 cash. 6K cash. Okay. So obviously we got some cash from that transaction. What should be the debit? It's always, when the cash is involved in the transaction, I always recommend to start the cash. If cash movement is involved, you always start with cash, and it will be the easiest way to manage that. So we say cash. Cash increased by 6,000. Debit. What's the credit side of the deal? It's a bit complicated there. We also know that our inventory decrease. But it will, okay, let's say inventory, merchandise. But we say we sold $4,000 of inventory from our warehouse. And, okay, inventory decreased by 4,000. But that thing doesn't balance at all. What do we do with 2,000? So that's, we have an asset, and that's also an asset. And here come revenue and expense account. So when we do transactions with the third parties related to revenue generating activities, like when we do the real business, not just financing like taking loans. No, when we do the real business, when we sell our merchandise, we need to reflect revenues and expenses. And here we come, revenue. So we get 6,000. Therefore, our revenue should also be 6,000. And our cost of sales is 4,000. Revenue but it still doesn't balance. So we are doing something wrong. Mathematically, if we want everything to balance, we need to make revenue with a minus and cost of sales with a plus. As you might have noted, when we have a negative amount here, for example here, it's always a credit. So we say credit revenue, debit expense. And let's go to debits credits. Did I put it here? No. Okay. That's interesting. That's a bit counterintuitive. Expenses behave like assets. Increase by debits, decrease by credits. Revenues behave like liability, equity. Increase by credit and decrease so you might try to remember that as a controversy. If you already learned that assets increase by debits and liability increase by credit, then for revenue it is like liability. It increases by credit. And expense increases by debit. So expense is the opposite of revenue. And asset is kind of the opposite of liability. And revenue, what it does is it directly corresponds with retained earnings, which is an equity account. So you can imagine intuitively then when you generate some revenue as an owner of the, so you are an owner of the business and your business is doing great. It has high revenues, low expenses, huge profit margins. All these operations will improve your owner well-being, and your owner well-being is determined by the size of the owner equity. So each time you do a profitable sale, your equity increases. So let's go back to transaction list. Because it can make things a bit complicated at that point. I will try to simplify that transaction, and you tell me if that helps. Okay, let's keep the transactions similar, but let's do one more transaction of the similar fashion, but present it a bit differently. Let's say 5K cash revenue generated. So we generated 5,000 cash revenue. It will be similar debit cash 5,000. And it will be, okay, let's even simplify it even more. 5,000 cash revenue generated from from sale of services. Cash 5,000. Debit cash, credit revenue. Okay, assets and revenue. So for example, we did a sale of some services. So owner works in the business and he did some services. I don't know, some accounting project or some consulting. And then owners use some merchandise in providing such services, and he figures out that he needs to reflect it in the expenses. So let's say 1 key of merchandise used in provision of the service. So what do we have here? We use the merchandise, so we need to decrease the inventory. Let me copy the account. We need to keep the names of the account consistent within the file, and I will tell you a bit later why we need to do that. So inventory merchandise minus 1,000, and that's assets. It decreases, so it's a credit. Debit side will be cost of sales, and it will be that same $1,000. So that will be an expense. Tell me in comments what way of presentation looks more intuitive to you. When we do like an entry for like 4 lines and try to figure out all debits or credits, or when we break down the entry into 2 parts and we first reflect like a revenue part of it, the part which generated cash, and then we match the cost of sales part to the entry. So you can send me one for this, or number 2 in the chat for this. Okay, I will add some numbers here. Okay, and we say that everything happened in period 1, and we probably, so that's an asset. Okay, we did quite a few accounting entries here. For the homework, we will do some more transactions from MIT materials, and we will probably, I see based on time, we will probably cover MIT materials separately, or you can look through them as your homework and read them and get MIT view on the concepts we covered today. I will probably do a separate email and message and Telegram message regarding what I want you to do for the homework. Because, okay, thanks. I see people like second approach more, and I agree. It's a bit easier that way. And what I wanted to tell you that session for accounting theory, that session is probably the most important one. Everything related to debits, credits, accounts assets liabilities accounting equation. You need to master that, and we will return to that over every lesson from now on, every hard skill lesson from now on. So if you have some questions or something is not clear in that session, you feel free to enter that into question list or to post as a comment to YouTube. And if I see that I'm missing out on explaining something, I will do a separate video where I will try to give you an alternative point of view and try to explain it differently, or I might give you some links to other videos or articles I know which explain that problem. So we are now at almost 12:30, and we need to finish up within the next half an hour. Okay, what I have on my schedule for today. Okay, solving transactions, QuickBooks setup. Does any of you at this point want and need any help with QuickBooks setup? If you do, you have my video, and if you still have a problem with that, you can send your problem to the messenger or to the Telegram or to email, and I will try to help you with that. For now, what you needed to do to be able to do practice in the future and is to register for QuickBooks for accounting, and it should be completely free. If you have trouble getting free account, ask in Messenger. And if you want to achieve more or take more from that course and you have time for that, you can start doing QuickBooks courses on bookkeeping and QuickBooks. I believe they have a basic course on QuickBooks skills, and the third one is QuickBooks certification. So if you are serious in getting into accounting and you think you need to start from the basic position, then QuickBooks certification is one of the best to get for that. It's free, and QuickBooks is used by like 80% or more of American businesses. It is mostly small businesses, but if you search the positions on the LinkedIn, you will see that most of them want you to, many of them want you to be able to deal with QuickBooks. Okay, so I responded to QuickBooks questions. I hope you already registered for QuickBooks if you want to practice it. And I also have Google Sheets set up here. And for Google Sheets setup, you will need to watch my video on the spreadsheet, and I will give you some understanding what I meant by Google Sheets setup. Let me try. Okay, this is my other Gmail account, my other browser, and what I want to do here is I want to go to homework, transaction practice, So what I meant by Google Sheet setup is you go here and you can download that file for your desktop either by Excel. So if you have Excel app, which I don't have on that computer, you can download an Excel. That way I'm showing you how you can download the document to do your individual homework. Or alternatively, if it's more convenient to you, you can make a copy. You can make a copy of the file from the homework. Let me send that link here. Can someone try if he can make a copy from the Google folder? And you move that copy to your own folder, so you do not create copies here. You just move it. Okay, let's just okay, I can move it to. Okay. Okay, can I move it to? Accounting game. Let's set up it this way. I will do a folder here, and it will be called homework public. And I put it here. And for the settings of that folder, I will make that folder editable by anyone. So you got access here. Done. Okay, done. And here I will say rename. Can I rename that? Okay, here it is. So I will say that this is Serhi Tel. You can use any alias. If you don't want to use your real name, feel free to use any alias. Just use that alias across all the course documents. So I copied it to that file. I will send the link to you now. So you can move your homework to that folder. That way I will have a quick access to it, and you will just do your own transactions. So for example, if I do a homework next week, I will go into that file and I will go to transaction tab, and the other file which I need to do a homework will be let's open schedule. I will put some instruction into my emails so that everyone will remember that. And okay. So in order to move to in order to find homework, let me update it on the schedule. Balance sheet. Okay, homework. I put link to the chapter 2 in the schedule, and at the end of the file at the end of the file you will be able to find the transactions which I want you to practice. It will be mostly similar transactions to what we already did, and something might be different. You might need to do some own research to do that. And at the end they offer you to practice to present them in the form of accounting equation, which is a bit more detailed. So we still have assets on one side and liabilities and equity on the other side. Okay, let's get back to our schedule. Roles. I will still wait, so we are not starting any teamwork this week. I will still wait. If anyone wants to sign up, I will start to manage the teams, like to allocate unallocated people to the teams. And next session we will have the first teamwork assignment. But so far you can connect if your team is formed. I'm not going to change any existing teams which has its own accountants. Where is my team file? How to form a team. So for example, we have a first CFO here. Congratulations. So if you go to the file, okay, team name, team number 4. What what I think we can do, if we go to our folder, here, we can start with let's start with a number, so the sorting will be easier. 1 team, and to simplify everything, let's say it's 4 team. Okay, we have 4 team, we have 5 team. So you can publish your individual work into that folder. You just copy that, and so far you will, for that homework, you will only need to work in the transaction list. And later we will complicate it a bit. We will start working in trial balance and we will start working in the balance sheet. But now we just have all these accounts set up. And now if we have a bit of a time, yes, you copy your file. I advise you to keep it here in that folder. Or you can keep it in Excel on your local computer. But if you keep it online, it will make much easier your communication with your team, and it will make it easier for me to go from time to time and make some reviews. Depending on the people who wanted to do the homeworks, I will be able to review several files per week, but I will not be able to review every file if there are a lot of submissions. That's why I advise you to keep it all in the shared file. Just don't mess up with someone else's file, but you also can go into someone else's file and review and see what entries they did. So I'm not making any strict laws against plagiarism. So you can, I even advise you, if you struggle with doing your own work, I advise you to plagiarize someone else's work. You just need to do it thoughtfully. You need to pass that work and process it by your own mind and try to understand what other person was trying to say. It's not a big deal. You are studying it. That's why I set it up this way. And the last piece, if you have any questions or if you have any comments, it's time to post them to the Q&A file. It's in the basic level of the folder. And the last concept for today's session, and hopefully we will also start with that the next session, because it's a bit complicated. Revenue, it tells you how your balance sheet and trial balance works. So we first implement a check here. So let's imagine we are tasked by a senior accountant to make our balance sheet balance. We have a transaction list and they say, okay, now prepare the balance sheet or trial balance. First step, we do trial balance. Sorry, I might have confused you. And what we need to see here is, wow, our trial balance does not balance for $18,000. What might have caused it? And if you see, it's already some if functions here, formulas, and I'm doing that on the team1 file. If you see here, it's already SUMIF, and I posted a spreadsheet video yesterday about SUMIF function. I won't talk a lot about it right now, but let's see, we are out of balance for $18,000. Let's see what happened here. For example, cash. We can go transaction one by one and see if these transactions are reflected here. So for example, if we go back, okay, cash is here. SumIf should catch all the cash, and we also apply an auto filter to that range. Data, create a filter, and we can pick clear and pick cache. Okay, and we select all of that, and in the corner here in the right corner on the bottom there will be a sum which will say that it is 19,000. Okay, let's try this. Okay, it will just complicate. So now it seems like all cash was reflected, and the other is equity, and I see only one contribution to equity here, 100,000. So these two seem to reflect our transactions. Okay, let's move further. You might not be matching my pace here, but that's not problem. You can later rewatch that part, or we will start our next session next week with that, and I will probably go over that in the next Q&A sessions as well. So we go here, we have buildings, cash, mortgage, and mortgage later we divide it into two mortgages. So let's see. Okay, buildings is here and mortgage is here. Okay, now sort this transaction. Okay, this should be number 2, 3. Okay, I kind of messed up. Inventory merchandise and cash is already here. Okay, inventory merchandise, we have that account. And mortgage, equipment and cash. Okay, we have an equipment, but we don't have a formula here. And once we put in an equipment, we see that our difference decreased to 6,000. Okay, equipment, cash, other receivables, 2,000. Let's see if we have that one. Okay, we have a different name here, accounts receivable other. So let's use this name. And our difference go down to 4,000. Okay, we got mortgage again, which we agreed to use. Let's say we settled non-current part of the mortgage. 6,000, but with the other side. Cash, inventory, merchandise, already there. Revenue, cost of sales. Revenue, cost of sales. And we add net profit account here, and we add a sum here. Okay, we have 0, but please note, and it's very important that you do not catch net profit in your formula. So now, at this point of time, our trial balance balances. But what about equity? So that exercise is very important for the equity. When we go to the equity, okay, here, in our equity accounts, we only have $100,000. but we already sold some stuff for the profit. And we get some net profit. It's a minus, but it's a profit because revenues and profits in our books, in the way our books are established, they kind of have negative signs. So it's okay. It's a profit, not a loss. If it was positive, it would be a loss. But it is a credit entry. So that credit entry, when you close the period, that credit entry will go into your equity. It will be retained earnings. And when you close the period, it will add to your equity. But it will go there on the balance sheet, not on the trial balance. On the trial balance, you already included it as balancing in that result. But when we do the balance sheet, it will go there. I believe I planned a balance sheet. Hard skills, balance sheet. Yeah, it's planned for the next session. And so that is okay. Oops. Okay. So that is the way your balance sheet balances and your equity grows. When you generate some amount of money during the period, you generate net profit, and at the end of your period, your net profit, when you close the period, your net profit increases your equity. I will show how it balances on the balance sheet on the next lecture. And today in the evening, we will have some rehearsal of today's lecture. If you want, you can come. If you come up with any questions, you can join the today's Q&A in the evening. I don't think you will do that. It was quite a bit of work for you and for myself. But at this point, I want to say thank you for staying online for so long and listening for the accounting questions, which is probably not the funniest things to do on Saturday, but we are still here. Thank you for your learning efforts and have the great rest of your Saturday. Bye bye.